Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's conversation. I've got with me today Edward Woodford, who is the CEO and founder of Zerohash. Zerohash is one of the OG embedded crypto platforms out there. We're going to learn about the journey over the last several years. I'm really excited for this conversation.
Yeah, good to be back. Nice to have a catch up.
So I looked at the last time we talked, and it was 3 years ago. So we're recording this in 2025, which means it was 2022. I think MoonPay had just raised $500 million for their on-ramp at a $3 billion valuation. We were in the middle of this NFT boom. Embedded finance was a big thing. You know, we had Drive Wealth and Synapse and lots of other companies that were doing open banking and plugging financial products into all of these fintech footprints. And we were about to go into this SPAC fintech boom with everybody making billions of dollars. And of course, that's when the crash happened and lots of people got lost in the desert for the next 3 years. Zerohash has not. Tell us where the company is today and what things look like from your seat.
It's been an interesting ride. You give a good synopsis of the past. I mean, look, I think one of the things I say is that the challenge of building in this space is narrowing your emotional bounds, right? You know, that was the absolute peak frothiness and not, getting above your skis, so to speak. And likewise, there was a pretty material downturn and then kind of narrowing the fearfulness and continuing to build. So, Zerohash, we built and scaled year on year since there. So we've grown revenue year on year, which is our key metric, and also scaled up volume. The way that we kind of describe the business now is that we are an infrastructure business for both stables and crypto. About 3 years ago, stablecoins were less than 5% of our volume. They are now 50% of our volume. The breadth of use cases has expanded from, for example, clients that are crypto native, such as MoonPay and Transact and Ramp, to increasingly Web2 or fintech native companies, whether that be, for example, groups like Shift4 or Nuvei or, for example, Stripe, and then new verticals that have continued to expand, such as tokenization. We now power, for example, stablecoin on and off ramping into BlackRock's Biddle Fund, Franklin Templeton's Benji Fund, Hamilton Lane's funds as well. And then obviously the brokerage space. So if you think about that, payments has grown. I would say it's broadened into more traditional companies, and we've been a big part of that. Then there's been the new space of tokenization, which has now started to get some decent traction. And then, we did also do a lot in brokerage 3 years ago. And I would say that business line more or less went on hiatus. It grew slowly, but that was largely because of some of the actions of the SEC with things like Sub 121, these accounting bulletins, which effectively made it uneconomical for groups to expand into the crypto space if you were a brokerage firm. And now when you look forward, we're sitting here and it's public that, major banks, Morgan Stanley, Charles Schwab, SoFi, have all publicly announced that they're going to do crypto products. And so that brokerage part of our business is accelerating very, very quickly as well. So that's kind of how we break down the business: payments, tokenization, and brokerage.
It's nice to have revenue as your North Star. I've seen some pretty crazy kind of volume sizes recently around different parts of this industry. So Uniswap, the on-chain DEX, recently announced that they've powered a cumulative 3 trillion of volume, which, for scale, Stripe, I think, does 1 trillion and change, give or take, per year. So Uniswap, which is like a team of 15 very smart kids, adults, professionals, built this machine that's huge scale. I think the Bridge acquisition into Stripe, the numbers that kind of float around there is volume somewhere between 5 billion, 20 billion per year. Can you give us order of magnitude? Like, where does Zerohash sit in terms of how much flow you power?
Yeah, so I think obviously comparing, a trading business like Uniswap, where the margins are sub bips, to obviously a payments business like Stripe, I would say is maybe a little bit of a false analogy. The margins that Stripe make are obviously significantly greater than Uniswap per se. But Zerohash processes tens of billions of dollars a year, and we're really proud of kind of our on-chain volumes as well.
Did you expect that when you were starting the business? Were you like, in 4 years, I'm going to process 30 billion of volume? Like, are you surprised by where you got to?
I mean, I wouldn't necessarily say surprised. I mean, I think I always want more. I'm a little insatiable. I mean, I think, when people ask me, hey, are you worried about your competitors? You mentioned, for example, Bridge. I think that the honest answer is no. I mean, we have the largest names in the space, and I know my volumes and I know my revenues. I want to get to hundreds, if not billions of dollars of revenue. And that has to come not from taking business from my competitors. It has to come from scaling the pie. And so, I still think we're relatively early. I think that the taps have come off. The SEC has taken a step back in the US. Every bank will now enter the space. The stablecoin bill, that will accelerate that as well. And then the Bridge acquisition by Stripe, it has really drawn a lot of attention to the space from Stripe's competitors, many of which are already customers of Zerohash. And so I think putting Stripe into context is also important. Stripe, although a very large and established company, a fantastic business, they actually only account for less than 2% market share. And so the other 98% market share are playing catch up or are starting to move very, very quickly. And so that will lead to more and more acceleration. But I think, the question of volumes, I think it really comes down to the applications of stables and crypto. If it's more of a merchant payments use case, the volumes are going to be smaller. You cited, for example, the Stripe number. If stables continue to disrupt, for example, cross-border remittances, those numbers will be much larger. But the margins will differ, right? And this is often what I talk about when we talk about stables and crypto. The margins that you can charge really depend on the use case. And that depends on what value proposition you're actually providing. People will pay for application and use case and usability. So to make that more tangible, for example, not sharing anything too confidential, our margins on for example, our account funding product is significantly larger. So our account funding product is effectively leveraging stablecoins to fund a brokerage account, a gaming account. So we have, for example, groups like Kalshi, which is an events-based trading clearinghouse in the United States. We're going to be launching a number of players, including clearing brokers and brokerage platforms, including Tasty Trade. So effectively there, you're leveraging stablecoins to fund your account. And the margins there are higher because the alternative is you don't fund your account. If you want to fund your account on a Saturday, you're happy to pay a higher fee because the alternative is that you just simply don't place your trade. When you basically look at remittances, what you're effectively leveraging stablecoins as is a mechanism to not have to pay cost of capital. And cost of capitals, as interest rates come down, you're talking, 5 to 10 bips is effectively the overnight rate. And so that's what you're competing against. So I think when we talk about volumes, that's often an ego number. That's why I talk about in terms of revenue. We talk about volume and revenue, but revenue really depends on the use cases that you're powering, and they differ based on the actual value proposition that you're providing through stables and crypto.
Yep, I'm with you. Let's dig in for a moment into this distinction the industry is starting to make between crypto and stablecoins, which tickles my fancy, I'll put it that way. Because the way I see stablecoins are as structured products and derivatives that happen to be trading on chain like any other token. And a lot of the story of stablecoins is the same story that Bitcoin used to tell us. We're going to have international payments in a store of value that is fit for purpose for digital cash. And this kind of payments use case that Bitcoin was supposed to have is now sitting with the US dollar. Can you talk a little bit about why do you think the fintechs are okay with stablecoins and why all these kind of new entrants and people that are coming into the space are happy to work with stablecoins, and why are they trying to shed the sort of crypto label? And whether from a company or product perspective, is there any difference or is just a repackaging?
Yeah, I mean, look, a great question. I think in hindsight, we were potentially a little slow around this bifurcation. And I'm actually very aligned with you philosophically about what you're saying. Look, a stable coin does not exist without crypto. And what that means is if you're sending a stable coin on the Ethereum blockchain, you need to pay a fraction of Ethereum. If you're receiving USDC on Solana, you have to pay a fraction of Solana, for example. So these two things are incredibly interwoven. And my mental model is more that there's blockchains, there's assets, and there's infrastructure on top. And I think that's maybe, similar to you, if you spent a long time in this space, that's kind of that's your mental model. However, we've had to adjust just based on the practical realities, and I'll let you know why. I'll explain why the realities have shifted. The first thing is obviously legislative. Here in the United States, there's been a fundamental bifurcation between crypto, which has largely been captured in the market structure bill, versus, for example, the stablecoin bills, either the Stable Act or the Genius Act. That is a big differentiator in terms of how these things are overseen, overlooked, and how you speak about these things. I think secondly, fintechs have become maybe more comfortable with stable coins more quickly than crypto for a number of reasons. And I think it's fundamentally driven by the fact that stable coins have some fundamental properties which crypto don't. Primarily, the stable coins, and I'm talking about the majors, right? I'm not talking about, the longer tail of algorithmic stable coins. I'm talking about centralized issue stable coins, which I think is what most people talk about. If we talk about stable coins, they are centrally issued. And what does central issuance mean? Central issuance means that you can effectively lock and block assets on the blockchains. And so that gives people comfort that effectively you are able to lock through a centralized entity those assets, which is obviously very, very different to what people deem to be crypto. I think thirdly, people potentially see more applications of stable coins beyond, for example, what people have bucketed crypto to be as maybe a speculative asset, which I think is a very, very narrow view of what crypto can be. But it's a simple heuristic that people that have been building in stable coins have really latched onto. So those would be the three drivers that I think have created a distinction, and a distinction that matters to buyers. And therefore, as the seller into these groups, you have to adjust. And that's why, for example, you'll in terms of what shifted in the last 3 years, the way that we frame the business, we are a crypto and stablecoin infrastructure business. We talk about our volumes, distinguish between stables and crypto. And so I think those are kind of important points. I actually think the construct of stables is even broader. So maybe you've heard it here first. But within stables, I think you're going to have this bifurcation between stable coins, right? USDC, USDT, ROUSD, and stable instruments, yield-bearing instruments. And again, I actually think that it's somewhat of an artificial distinction, but one that is actually going to be distinguished largely for legislative reasons, that in the United States, stable coins won't be able to pass interest, whereas stable instruments will. And the way that we've defined and the way that these things are licensed and regulated, for example, stable coins they can be much more fragmented or fractionalized rather. They're much more programmable. They're much more easily transferable. And when you compare it, for example, BUIDL or Benji, where BUIDL has a $5 million clip size, there's some limits in terms of permissions, in terms of transferability. But ultimately, I don't think that those distinctions should exist between stable coins and stable instruments, but they will, partly because of legislative reasons and partly because of application reasons and technical distinctions that currently exist.
Yeah, it's an interesting point. I mean, my current thesis is that stablecoins are the distribution mechanism for yield-bearing RWAs. So you have these large chunks of institutional collateral that have a bunch of permissioning on them, but then they collateralize currency. That currency can float around and live in applications and be applied. I mean, your business is very global, and the regulatory posture has changed so dramatically in the last 6 months. I'm sure you were paying attention to MICA in Europe and the stuff the UK is doing. And then, in Singapore and Hong Kong, there's things going on. The MAS is always pushing the Hong Kong dollar. Who are the live players in regulatory policy now? And what is really driving it? Like, what's the reason for it? I know there's been a big political push on the Republican side in the US to unlock crypto, and part of that is the industry's lobbying efforts. What's really going on in terms of where the leverage is coming from?
Yeah, so Zerohash, we operate in 200 plus countries. And, we have licenses and entities in, for example, Canada, Brazil, Bermuda, where I was last week, the Netherlands, which is a kind of our MiCA hub, Australia, New Zealand. So we take a very global view. In terms of, what's driving each of these factors, I think, for example, in the US, I've been to DC, I think, close to 8 times already this year. And I think there's a couple of drivers primarily around overreach of government. And for example, Sub 121 is this very niche accounting bulletin, but effectively the government's own, what is called the Government Accountability Office. This is often missed. The government's own Government Accountability Office during the Biden administration actually said this was a governmental overreach. And both houses actually agreed, both chambers rather, both agreed that this was a overreach by government, and it was actually, overruled by Biden. I think what shifted was this pushback of governmental overreach that existed, and has actually been a relatively bipartisan issue. I mean, both the House and the Senate agreed that Sub 121 was an overreach by government, and so I think that's the abiding force. I mean, I am, friends with some of the largest donors to the campaign. And often they start the conversation with, I'm not a Trumper, but. And then the story that tends to be told is one of pretty scary government overreach. I have friends who have had the FBI turn up their house purely to ask questions, right? The SEC, and people talk about regulation by enforcement. I think that's actually missing part of the story. I mean, regulation by enforcement is actually much more in the open. There's actually, what was very nefarious was what I would call regulation by implication. So having the FBI turn up at the exact same time at you and your co-founder's house is implying that you're doing something wrong, and we will continue to push on you. If you look at the FOIA requests that have come out, and Coinbase has done a fantastic job of this, if you look at what the guidance letters that were being provided by the banking regulators, they're effectively saying this is a highly risky space. And if you do something in it, we will make your life hell. So I think it was this visceral pushback against both what was very much out in the open, which was regulation by enforcement, but actually a much more subtle, maybe not even subtle, but much more not in the open regulation by implication. And that is what I think drove people to move into one direction. And I think it's what, frankly, now there's actually very little pushback from both sides. I think there's actually largely bipartisan support. And, I hope I don't jinx it for the stablecoin bills, but largely bipartisan support. What's left now to get over the hump is relatively minor, and it's largely been politicized. But I think that's ultimately what drove the conversation in the United States. And clearly, other places like Europe saw an opportunity to take advantage of some of the challenges in the United States. And I think it's a pretty simple story. Robinhood invested very heavily in Europe. Obviously, they bought Bitstamp. And Robinhood is actually, people think of them as a brokerage business. I actually think of them both as a dominant brokerage and payments business. And when Robinhood does something, other people pay attention. And I think, honestly, Robinhood has been the greatest marketing tool for Europe because it showed a massive US entity spending significant time, significant resources in Europe, and it drove the conversation to Europe.
There's still a bit of reluctance in the US and some pushback on the Genius Act, and there's still a portion of the anti-crypto army. But I think this reframing of stablecoins into something equivalent to a payment rail, even though technically it's not really what's going on, and distributing it through every fintech possible kind of de-risking, using a different word and de-risking it. And, like I'm going to go on a rant here because it's so offensive to me, honestly, that because the word crypto sounds dangerous, it's bad. And because the word stablecoin sounds stable, it's good. Like I feel that's the level of engagement that we get as an industry from the entire world. And it's just ridiculous. I mean, the word crypto is a fantastic word because it implies cryptography, and cryptography is safety and security, and effectively is what was dispositive for the outcome of World War II, like being able to crack the communication secrets of one side versus another. It's like sophisticated math. And all it's taken to drive institutional adoption is to replace a scary word with a word that sounds a lot nicer.
Yeah. I mean, I've been in this space since 2017. I bought my first Bitcoin in 2015. I'm very much a true believer in terms of what this technology can do. But ultimately, if I have to change the framing, that's okay with me. And maybe that's just a pragmatic optimist. But if we had not changed the framing, you get bucketed into one section. And this is what sometimes frustrates me around relative new entrants into stablecoins. People within the last 2 years, when I entered, stablecoins weren't a thing. Actually, stablecoins, the market cap of stablecoins were actually significantly larger 4 years ago. I think as a founder, like my principles haven't changed. The framing has had to change. And like I said, we were a little slow, but ultimately if the regulatory and the business way that people are thinking about things is shifting and creating this artificial distinction, despite the fact that ultimately they are built on the same fundamental technology, that's okay with me. But you do sound very similar to me behind the scenes in terms of my views on these things. But you have to adapt in terms of marketing, and that otherwise you get bucketed as an outsider.
Let's talk about the use cases. And you mentioned a couple of pillars of growth. I am interested in this delta between the embedded brokerage business, which a lot of the consumer footprints, whether it's the Robinhoods or Revoluts or whatever, need an embedded crypto brokerage business, versus the emerging payments use case, and payments split out into treasury operations and remittances and commerce, all of this. We've all been waiting for commerce to catch up to trading as a revenue driver in Web3, and it's taken a very long time. Can you reflect on why that is? And then when you look at that question as applied to your business, like what are the primary sectors or business types that are getting traction and growing really well within commerce and payments?
Yeah, absolutely. So I think there's often this mindset that just because you can, people will, right? Just because people can pay with stable coins or can pay with Bitcoin, they will. Again, it goes back to value proposition. Actually, if you look, customers don't care that the interchange rate is 3%. They get their points and they're happy. So I think you have to unlock true value for the user, not only for the merchant. So maybe in terms of, I'll just focus on pay-ins, or what we call pay-ins, which is effectively, I think, what most people view as the payments use case. And then I'll go broader. The fundamental point with pay-ins right now is it's clunky. And to expect a customer to think not only in terms of assets, right? USDC, USDT, ROUSD, Bitcoin, but not only that, but in terms of chains. So USDC is now on 20 different chains. That is an unusable UX. And so what we've really been talking about for the last 7 years is distributing this infrastructure, solving the complexities from a technical and regulatory perspective. I believe that the next 7 years will actually be focused on usability. And that's where we're diving in pretty deeply to allow a customer to think more in terms of account to account transfers. I am paying, Equinox for something, or I'm paying Netflix for something, as opposed to I need to think about what asset is this and on what chain. So I think fundamentally the reason that pay-ins haven't taken off largely is because of a usability challenge. And then secondly, I think it's a lot of people have been focused on the wrong areas. Allowing me in the US to pay for my Starbucks in stable coins brings very little accretive value, both to the merchant and to myself. Where I think it makes a lot more sense is outside of the United States and largely subscription businesses. So these are low value transactions where the margins can be pretty tight when you are moving money across hundreds of different countries and the costs of doing so. Now, the challenge with stablecoins is that they're exclusively a push payment right now. I have to actively log in to pay my Netflix every month. Again, that is a non-usable experience. So we are increasingly, and we've announced that we're launching a subscription business payment method for people outside of the United States, which I think is incredibly exciting. So you've got to abstract away the complexity of chains, and you've got to abstract away the complexity of me logging in every month to pay every single one of my subscriptions. That is just not a usable, practical payment method. So I think those are the problem sets in terms of pay-ins that we're pretty passionate about. In terms of payments more broadly, where we're seeing exceptional demand is, for example, stablecoin payouts. So this is, for example, you can go to remote.com today and you can pay out people globally through Zerohash. I believe that every two-sided marketplace in the world, whether that be, for example, a content creation platform, whether it be like a Replit or an Upwork, will offer stablecoin payout methods. And the reason for that is because it allows for true value for the user, which is, hey, if you're a freelancer in the Philippines, you can be paid effectively instantly and you actually get your value and you hold a tokenized representation of $1. So we launched our payouts product at the end of last year. We've now paid out in close to 100 different countries. And, that business is growing very, very aggressively. And people are happy to do what people sometimes term as the last mile because the value proposition is there from a utility standpoint. It's cheaper, it's quicker. Then another payment method that's growing very, very quickly is what we call our account funding product, which I outlined before, which is effectively that you can fund your account 24/7, 365. So if you're funding a gaming account, a brokerage account, that has real value proposition. And then, there's obviously the remittance use case, which is effectively what some people have called the stablecoin sandwich, which is, for example, US dollars to Mexican peso and using stablecoin as the intermediary hop. And there, the value proposition is effectively that you're not paying the cost of capital because that's largely how it exists. That use case, I think, continues to evolve. But those are some of the payment use cases and some of the frictions that I think have been solved or need to be solved. What I think people miss on stablecoin payments is one thing. This is going to be an incredibly powerful APM. In the last 18 months, 750 million people now have access to this APM through a primary account. And what I mean by primary account is, for example, a PayPal, a Revolut, a Nubank, a Robinhood, a place where I hold money today. And those groups have all embedded stablecoins natively. And I think you'll start to see more and more fintechs such as Cash App do the same. And what's really exciting about the stablecoin bill is that every bank will be able to do the same. So this becomes a very powerful alternative payment method from a distribution perspective. Now, this technology is now distributed, but like I said, for it to be usable, there has to be this abstraction away from the concept of multiple chains and multiple assets. If I'm sending Lex USDC on ETH and you want to receive USDC.Sol, making me think about that is an unusable UX. Same thing, if JP Morgan launches a coin and I'm at JP Morgan at your city and I want to send you JP Morgan coin, but you can only accept Citi coin, that is an unusable UX. So I think the interoperability standpoint is a really powerful piece and the user experience is pieces that are there. But I'm very, very bullish in terms of this distribution of technology. That's where I think we are in 2025. I think over the next 12 to 18 months, the usability story starts to get there too. And that's where you see a massive, massive uptick in the payment use cases, hopefully powered by Zerohash.
I wonder what the industry structure looks like in 3 to 4 years. The reason I ask this question is irreconcilable facts in my mind about the payments industry. So fact number one is B2B international cross-border flows are infinite. It's not a monopolizable sector. It's just enormous. There's space for so many different players. And fact two is in every generation of fintech, and I consider blockchain and crypto and stablecoins and all of that to just be financial technology, there are good companies that try to tackle the cross-border problem using the tools of the day. So TransferWise with replicating bank accounts in every jurisdiction and then settling themselves the risk to cut down on the time it takes to move money because the money's not actually moving. They're just moving the numbers around in the bank accounts they have. And then before that is companies like Payoneer, who maybe were a little less efficient at doing it, but did exactly the same thing. And companies before that are the card networks and the Swift and backwards and backwards and backwards. And it feels like there is a insurmountable problem, and every cycle there are kind of companies that come at it and build to pretty large size. And at the same time, there's like new entrants saying the problem's still not solved. Like, we got to do it a different way. We got to do it a different way. With that context, what do you think the industry structure in this payments space looks like? How big can somebody get? Like, who do you replace? What's the shape of market share? And then, like, are we doomed forever to repeat this? Like, in 5 years, are we going to have the quantum, money balancer? Like, why does this keep happening?
It's obviously a big question. I think maybe just going to first principles. What do blockchains and payments leveraging blockchains, what does it disrupt? Does it disrupt more the PSPs or does it disrupt the networks? And my view is that it is more disruptive of the networks, the Visas, the MasterCards of the world. Stable coins and these distributed networks on which they're built, I think, is one challenge. It's one alternative payment method. It is an alternative network to what has historically been the dominant, networks. And I think that's the challenge point. But that's no different to, for example, government-built networks. So, for example, PIX, the explosion of PIX and the threat that places on, for example, Visa and MasterCard is material. So I think in terms of the disruptive nature and market structure, I think stablecoins are part of that market grab away from Visa and MasterCard, but it's not the only driver. I think secondly, it is a competitive threat to the Swifts of the world. And I think that the threat that it places is largely on, I would say, the downstream correspondent banks. If you're one of the largest correspondent banks in the world, such as this, or, like a Citi or a Bank of America, I think you have a major incentive to launch a stable coin or to leverage stable coins. And what does that do downstream? If I want to send a payment to the Philippines, I think it goes through 3 or 4 hops. And I keep mentioning the Philippines because it's a large area for us. It's a large place where we have people, so we know the pain points very well. So I think the disruptive nature of this in terms of market structure, I think it disrupts and eats into the share of MasterCard and Visa. I think it eats into the share of Swift. And I think it potentially displaces, depending on how aggressive a group like Citi is, downstream correspondent banking relationships. And I would be very nervous if I was a partner of Citi downstream, if Citi were to launch a stablecoin, which they're rumored to be doing. Because then they don't need you. Then you can basically go from a multi-hop remittance through 4, 5, 6 banks to maybe 2. And maybe they have entities in both those jurisdictions as well. So that's what I think is the disruptive nature. That's what I think the market structure looks like, is, eating into those, what is largely oligopolies in those spaces. It will compress the oligopoly of Visa and MasterCard. It will compress the oligopoly of Swift, but it may actually allow for more concentration for the correspondent banks.
If we now switch over to the brokerage side with the trading business and those revenue pools, and to kind of rewind back, there used to be this narrative about like all financial products are going to be embedded and you're going to have super apps delivering you every financial product. And I think a bunch of that is true these days. Revolut and Robinhood, SoFi, and a few others are multifunctional and work as your bank account, as your trading account, as your payment account. These things used to be quite separate. And I remember for Zerohash, like this, the embedded finance story was a big part of the strategy. What's your view on that product line, crypto brokerage, and what do you see as the major trends? We can touch on the tokenization of securities because I think a bunch of that is back, but like that's still the largest revenue pool out there. How do you treat it? How do you compete in it?
Yeah. So I would actually say that, actually our payments business is larger than our brokerage business now. But in terms of the crypto story, in terms of crypto brokerage, again, Robinhood has been the greatest pitcher of Zerohash, because if you look at their most recent financials, I think it was 40% plus of their revenue came from crypto. That is pretty extraordinary. And so, we've been saying this for years, and I think this is starting to play out, that every traditional brokerage platform will have to have crypto, and every crypto platform of size will have a traditional equities, a traditional banking product. And you start to see that play out with groups like Kraken by, for example, Ninja Trader. They've obviously launched an equities product. So I think that this intersection is only going to increase. And the unlocks for the brokerage platforms. So if you look at who launched crypto in the United States of size, Interactive Brokers is one of our customers. I think they're a $65-70 billion publicly traded company. Fidelity launched a crypto product natively themselves. Robinhood launched the crypto product. What is the commonality between these? None of them are bank holding companies. And what people misunderstand about banks, so for example, Schwab or SoFi, is that even if you have a brokerage entity that is completely distinct, being a bank, which means you effectively sit within this bank holding company, the restraints and the constraints exist on all the subsidiaries under that bank holding company. And so what's shifted with the OCC guidance that has come out over the past few weeks, which has effectively overturned the regulation by implication, the wink wink, the pretty explicit points that if you do something, we are going to make this very, very difficult for you. The banks are now entering the space. And that's what's going to fundamentally dictate the evolution of the brokerage space. Is pretty much every bank has a brokerage business. Morgan Stanley has E-Trade. SoFi has a brokerage product, what they call their invest product. And those groups publicly have stated that they're going to launch crypto. And so the brokerage business is only going to go one way. A lot of brokerage businesses are looking at the revenues that Robinhood makes, and it's a very significant potential lever if you're the CEO of a brokerage business or a bank. How, if you can get half the success of Robinhood, you can grow your revenue by 20%. There's very few other opportunities out there. So I think those are the driving factors. And the unlocks that have happened have been obviously the SEC withdrawing their actions against groups like Coinbase. Obviously, the OCC guidance that has come out that has unlocked the bank holding companies. And then the repeal and overturn of SARB 121 with SARB 122. And that's what has driven the acceleration of the brokerage space and which will continue.
It's interesting that this generation of financial companies are building effectively bank holding companies that are multi-line financial product and manufacturers. They just find a way to do it in a modern way, which moves the risk off into different places. And I think blockchain-based finance collapses everything, every single product into a single market venue that you can then, in a pretty seamless way, integrate. So like a super app, like Citigroup is a super app. It just has to make everything and manufacture everything using the old steam engine ways rather than, using electricity the way that a Robinhood can bring that to bear. Is that right? And do you think the regulatory gap can close to sort of refresh the older generation?
Look, I think when people talk about stablecoins as, for example, a global banking network, I think that there's some truth to that. But also, you mentioned Payoneer. Payoneer offers accounts to people in hundreds of different countries. And there is obviously a difference between holding a stablecoin versus, for example, holding $1 in a bank account or in a brokerage account. It's not FDIC insured. It's not SIPC insured. Often you don't earn interest on stablecoin balances. So there are these differences and nuances. So I think it depends on the market that you're looking at. If you are in the US today, does it make sense for you to hold stablecoins as a store of value? My argument would be largely no. Does it make sense in the US to use stablecoins as an alternative payment method? Yes, significantly. So I think I think less in terms of these binary distinctions between old and new. I think it's going to be a blend. And that's obviously where Zerohash sits, which is effectively this bridge between old and new and providing those services. So I think it's less of a binary piece in terms of the future of how we think about financial services.
Yeah, I definitely hope so. And I think there's going to be an adoption curve for everybody to come to the table. When you look at the big banks, there's also been kind of a reshuffling as to who's the most innovative and is interested in being on the frontier here. You know, we know kind of the asset managers, right, that have products to offer. So the BlackRocks, Franklin Templetons, Wellingtons, Wisdom Tree, those kinds of companies. We know the market makers are there. So everyone from Citadel to Jump and so on. If you look at the banks, who do you think is the most risk on in terms of getting into market?
I think if you look at right now, the banks that are most risk on are the banks that have brokerage businesses. It's a very defined application, right? Customers want to have Bitcoin in their portfolio. We want to offer that. We see the outflows from the bank today to that's what's ultimately shifted. When I talk to execs at banks, I say, what really shifted for you? And often it's actually looking at the data about how much outflow there is into a Robinhood or a Coinbase, etc. And, you know, once those customers experience those other pieces, people start to consolidate their banking and kind of other services. Again, I don't necessarily know if it's risk on. You know, I think that they can launch this in a way that is very applicable, and these bank partners that we're, you know, that are either customers that we haven't announced yet or that we're talking to, they're obviously very conscious of the risks that they're taking and the mitigations that need to be placed. But I would say that they're the most, maybe I would use the word bullish around this space. And then I think in terms of the stablecoin application piece, I think there is a little bit of an element of wait and see. But to your questions to me earlier, what are the applications of stablecoins that really matter? Some of these groups are asking those questions. And, you know, there's a less defined business use case right now. People can look at Robinhood and say 40% of their revenue is generated from Bitcoin buy and sell. We need to do the same. Whereas they can't look around and say, you know, X is making Y from stablecoins. So I think they're in a much more strategic discussion right now on stablecoins. But like I said, I think the banks that will be much more maybe at the tip of the spear versus risk on will be the correspondent banks, just because they have so much to win there.
That makes a lot of sense and really insightful. I learned a lot from our conversation today and glad that we got to reconnect. If our listeners want to learn more about Zerohash or about you, where should they go?
Yeah, so you can follow us on X, which is just Zerohash X. You can follow us on LinkedIn. And then my personal X is E_Woodford.
Fantastic. Thanks so much for coming on today.
Thank you.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.